Biden's tax plans. What are they? Who wins and who loses? The Biden administration's Build Back Better agenda is built on three massive taxing and spending programs. The three programs are called the American Rescue Plan, which already has passed, the American Jobs Plan, which is working its way through the Congress now, and the American Families Plan, which comes next. The three are being framed as COVID relief, infrastructure upgrades, and aid to families, respectively. Collectively, these represent nearly $7 trillion of additional spending above and beyond the usual $3.5 trillion and growing that the federal government spends each year. At an added cost of more than $20,000 for every living American, that's quite a spending spree. So you might be wondering what all this spending is for. And we may address that in a future episode. But for now, we're preoccupied with where all this money is supposed to come from, especially when we're already running enormous annual deficits and with the national debt having ballooned to $28 trillion with no plan in sight to pay it back. So after taking a super quick look at the main spending categories in the American Jobs Plan and bypassing the question of how it's possible for responsible politicians to contemplate even another dime of new borrowing, we dive into the biggest of the tax law changes that are being proposed. These include raising corporate tax rates, raising individual income tax rates, raising capital gains tax rates, eliminating what's known as the step-up in basis principle, and changing estate planning laws to make it harder to transfer your wealth to your heirs. In each case, we share the strategies we'll be discussing with our clients to mitigate the impact of these changes in the event some or all of them are enacted. And near the end, we'll boil it down to who are the biggest winners and losers from the tax changes that the Biden administration is pursuing, not including the future generations that, if the pattern holds, will get stuck with the bill. All that and more right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here as always with Erik Olson and Adrian Nicholson. We have a great topic for you today. We're going to talk a little bit about Biden's plan. Before we get into that, Adrian, how was your weekend? How are you doing?
I'm doing good, Roshan. I'm happy to be here on another episode of the Retirement Lifestyle Show. Like you mentioned, I think we have a really good topic today. Might get into some back and forth, some heated debate, so I'm always looking forward to that. My weekend was pretty solid. Just spent some time with some family and friends. So, that's always one of my best weekends when I get to do that.
Yeah, Erik, how about you?
Yeah, well, we had family in town, which is great, and then friends we had not seen in 34 years. So that was it was unreal, surreal almost, just to see how much that friendship had stayed alive, despite the fact that we hadn't laid eyes on each other and all that.
Oh, that's great!
And I finally got my birthday grill, all the grates seasoned, so that's awesome. So I'm geared up now for the Memorial Day twist here and getting out there and doing a lot of grilling. How about you?
Well, actually, I was grilling this weekend. I plan to do it again on Memorial Day. I'm just not on Monday on Memorial Day itself as well. That should be fun.
Fantastic.
Yeah, that's really exciting. I mean, I really tackled like the grilling challenge last year, and it is really difficult. Just making sure everything like the temperature is fine. Just even it took me a while just to figure out how to turn on my old grill too, but I think I got a little better at it last year. But it was a lot of fun, kind of hosting like my own little barbecue last year. But it is a challenging task.
Oh man, I now have grill envy though, because my son-in-law has one of these incredible gizmos where essentially it's electrically driven burning of pellets. It regulates by an app on your phone precisely the temperature and hence the feed of the pellets into the chamber. Everything he prepares is perfectly done. It's so frustrating. I thought, why did I get my rinky-dink charcoal griller? But anyway, we're there.
That sounds high tech. Does this grill have like semiconductors in it, Erik? It sounds like it's.
I have never heard of this kind of grill before.
Yeah, it's. I mean, if you have technology envy, it's gonna max you out there.
I wonder, on to our topic. I wonder if he gets a tax credit for that, since it sounds energy efficient. But so today we're talking about Biden's plan, the Build Back Better plan. We're going to go a little bit more into what's proposed right now. What the plan includes: the American Rescue Plan, which is passed; the American Jobs Plan is what is currently being negotiated; and then the American Families Plan. We're going to spend a little more focus today on how this will affect you, the income earner and the investor, and what you can do about it. So I think, in my mind, that's the important thing, just because uh, as a voting American, I feel like I have no say in what's going to get passed in Congress at all. My vote's been cast, and we've essentially got people in there. They're going to work it out. So because I have no say in it, I've just got to react to whatever happens. And that's what we want to prepare you to do. React to what will actually get through. Now, we don't actually know what's going to get through, so it's really about what's proposed. So let's talk a little bit about this plan, gentlemen, and then talk about what you can do about it. So first, starting with what's currently being negotiated, or even taking a step back, the Build Back Better program, the American Rescue Plan was supposed to help Americans affected by the pandemic. The American Jobs Plan, the focus on infrastructure, manufacturing, research and development, and long-term healthcare services. Then the American Families Plan is going to focus on investments such as education, childcare, healthcare, and expanding tax credits. The numbers are ridiculous. Eric, tell us the number of these three plans. How much is being spent or proposed?
Well, yes, collectively, somewhere between currently 6.4 trillion and possibly $7 trillion. And bear in mind, when we say that, some of that's immediate. So in the case of the American Rescue Plan, it's accelerated spending. In the case of the American Jobs Plan, that would be spent over 8 years, although the taxes to support it would be are allegedly going to be collected over 15 years. We all know how much continuity there is in tax policy, and so the likelihood of it actually being funded over those 15 years, in my view, is suspect. And then much of the American Families Plan, at least as introduced, is a 5-year extension of or an expansion of several tax credits, as well as some additional spending. So the spending is spread out to a certain extent over 5 to 8 years in the second and third cases, and then concentrated now in this year and the next in the case of the plan that's already passed.
Yeah, well, yeah, and so when we have a number like this, at 6.4 trillion, that's just a number, right? And it's hard to imagine that in dollars terms. Mm-hmm. So I've done this before. I looked this up again. What does that mean in dollars terms? And the most interesting one I found is that 6.4 trillion can pay for everyone in Congress for 68,748 years. Right. And if you think about that number, our nation's been around for 245 years. Right. So you're spending enough to pay for Congress for 68, almost 69,000 years. The number is insane. Right. It's just hard to fathom a number that big. So.
Yeah. It is incredible, Roshan, just like wrapping your head around that number. And I think we mentioned it in a previous podcast, is just kind of follow where the money is going, because there's going to be so many programs, changes, and just, how does this boil down to the individual voter? Like you said, how does this boil down to the individual level? How is this going to affect your plan going forward is a big question people have, because it's just a lot of money's being spent here. There's a lot of new things that are going to be coming out. So it's just really important to look at. how this developed and how this changes and how this can be incorporated and how you're going to deal with this, I think is a really tough topic for people to really do their own research and just seeing how this is going to apply to them. Because again, there has been a big shift in administration. It went from a Republic to a Democrat, and now it's going to be, and you see all this money coming out and being spent. So it's definitely a very polarized topic, and it does, like, spark some heated debate sometimes where people say, I think it should be spent on this. I don't agree it should be spent on that. So that's always like an interesting discussion just to always have and to always look into. That I think it's,
well, I want
it's
to
just
add
going to be
I want to phrase it and just
today.
and augment what you've just said with just an additional viewpoint on this. If we said there are essentially 330 million Americans, then 6.5, we'll just round it, $6.5 trillion of additional spending is essentially the equivalent of $20,000 for every man, woman, and child in the U.S. And so, you think about that level of spending on top of what we already spend, and really taxation. If taxation were paying for it, then you're talking about an additional $20,000 of taxes as well on every person in this country, if it's fully paid for. And if it's not, that's a problem all its own. More deficit spending, more national debt.
We talked about this on our crypto episode, but when you hear numbers like that, doesn't the whole store of value argument for crypto just seem to resonate? You can't. No policy, theoretically, right? Theoretically, no policy can come out and just say, all right, we're printing 6.4 trillion more tokens to cover this.
Right. Then there's also the interaction with the economy. And so we've got enough to talk about today just on the nature of what the bill, particularly the American Jobs Act, now is proposing. In a previous episode, listeners, we had talked about the American Rescue Plan, so you can go back and hear, our discussion of the proposals in that particular case. And since it's really a little too early to see the American Families Plan entirely fleshed out, today we'll talk mostly about the American Jobs Plan and some of its proposals, but with a heavy emphasis on what the tax consequences will be, who are the winners, who are the losers. And we'll leave aside also. Go ahead.
Yeah, that is. Yeah, you can continue, Eric. Oh yeah, I was just what we were just discussing. And I'm excited for some of the points that you brought up. But it's just a quote my professor always said is there's so much cheap money moving around in the system. So I'm just kind of wondering what his reaction is when he hears all these spending numbers. It just makes me go back
what's
just
in the
to
plan
think about it
really, really quickly so we can spend more time on the tax piece. So whether this is the right way to look at it or wrong, I'm definitely open to both sides of the argument. But I've told you my approach is I can't really control where it goes. So let's see what's going to impact me, which in this case would be the tax plan. So we'll touch on that. But just really quickly, the American Jobs Plan has $621 billion in infrastructure spending, $590 billion in manufacturing, expanded home care services of $400 billion, clean energy tax credits of about $400 billion, improving schools, childcare facilities, VA hospitals, $328 billion, investing in broadband, the electric grid, clean drinking water, $311 billion. So this portion of the Build Back Better program is totaling up at $2.75 trillion as proposed. Most recently, I saw that Congress was going to counter with a $1 trillion plan. So we don't know exactly where this is going to end up. But let's talk about what's proposed on the tax side, and then we can go into those winners and losers and what you can do about it. So I'll start with the first thing on my list of impacts on taxes, and I'm making sure I've got the right piece up here. So the first one I'll mention is the payroll, individual income tax, and estate tax. So what they're going to do is, right now you pay a payroll tax. So if you're working as a W-2 employee, it's split between you and your employer. If you're self-employed, you pay the entire amount. The payroll specific old age survivors disability insurance portion of it, you pay up to $137,700 in income. So if you make $200,000 in income, that remaining 62,300 above 137, you're not paying that tax on. Well, what they're going to do is they're going to bring it back for people that make over 400. So if you make up to 137.7, you pay it and then you don't anymore. The proposal is that, well, if you between 137.7 and 400, you won't pay it, but above 400, you're paying again. Gentlemen, thoughts and comments on that?
Well, yeah. So let's also mention that there's another 2.9% shared between the employer and the employee, yes, or for self-employed people absorbed entirely by the self-employed, that's on Medicare, and that goes on throughout the entire stretch. Yes. So it doesn't stop at the 138,000 that you mentioned. Yes. But if you said on top of all the other taxes that we're talking about, if they then further add 12.4%, reimpose 12.4% in what we call Social Security taxes, that's the short name for it, on top of the 2.9% in Medicare taxes. And then they do this coupled with several other important taxes that we're going to be talking about in just a second.
One thing I want to interrupt you on, though, is that that Medicare portion, that's unchanged.
I do. Yes, I agree.
Same.
I'm just saying when you sum it all up.
I just want to make the point. That's not a part of the planned change. That's current.
Correct. So, we could detail the entire list, but that will be still another, if that's indeed passed, that's still another incremental addition. So, those of our clients in, let's say, New York or California, who would be in the highest tax brackets, if all of these taxes are imposed, would have a marginal rate from all sources in excess of 62%.
Yeah. Yeah, well, and let's continue on with that. You touched on it already, but top individual income tax. Well, one thing I think I need to say before that 62 that Erik mentioned includes state tax as well. So through this, Biden's plan, the Build Back Better plan, this is all federal stuff. So the federal can't impact the state.
Yeah, we're talking about federal.
But right. I want to get back to the next thing on here, which sort of touches on what you said. The individual income tax rate for incomes over 400,000 will go up from 37 to 3.96. So if you make over 400,000, that 12.4 comes back. In addition to that, the 37% is going up to 39.6. And right now we're still talking about income currently. We'll continue on that. Any comments on the step up in income in the income tax?
Yeah, I've got comments, but Adrian, did you want to chime in on that?
That's definitely going to be a big one. And like you said, this is where it really boils down to the individual seeing where your income level at and is moving forward. And I think the listeners would really enjoy or like to see, if you were in this kind of category of being pushed up in income, what are going to be the strategies or kind of workarounds what you can do to kind of manage this going forward, and how do you overall prepare for this?
So
are there strategies on the
first
way,
I
or
qualify the comment about $400,000. So Biden has used $400,000 sort of loosely, and so have various people within representatives of the White House. We're not sure yet, honestly, whether that the 37% you mentioned, the 37% rate is going to go to 39.6 under this proposal. Mm-hmm. But another component of that is this sort of a little bit more subtle, is perhaps the shift downward in where that 39.6% rate kicks in. So currently, the 37% rate would kick in for a single filer at a little bit more than $523,000 of taxable income. By the way, that's not the same thing as gross income or adjusted gross income. It's a lower number. So, but anyway, $523,000 of taxable income for a single filer, or for a married couple filing jointly, a little more than $628,000. If you both move that number down to the $400,000 level, does that apply to a single and to a family, a married couple filing jointly? I mean, to whom does it apply? So you move way down the income scale and you impose a 39.6 rate on that as well. Then that's not jumping it really from 37 to 39.6. That's jumping it from what in many cases would be, let's say, a 32% to 39.6. And coming back to the point that Roshan, you had made just a few minutes ago, if the FICA component or the Social Security component of 12.4 is added to that, now you're at 52% marginal rate on incomes above of $400,000 when you had been at about 32. So
hold on, Eric, just to continue down that path, that 32 jump for married couples is definitely huge. But like you said earlier, I think it's important to note that could also affect singles. Now, it wouldn't affect them as much going from 35, but
correct.
Where it starts is such an important piece. Who's it actually going to affect?
Exactly.
Do they just pick a random number? And I did look up what percentage of Americans make over 400,000. That number comes back at about 1.8%. So I can see people saying, well, it's or the counter to that is, well, it's not affecting then 98.2% of people. Yes, that's true, but a part of me also wonders if it gets approved at this level, is it going to sort of start moving down and affecting everyone else? Like just using that Social Security tax, if you approve it at over 400,000 now at 12.4, at what point do they just eliminate that gap between 137 and say at all incomes you do it? So that's kind of what I'm wondering as well.
I wonder about that point, the trickle down effect as well, because you think, okay, 1.8% of all taxpayers, but what percentage is that of all people who are employing people?
Yeah.
So if you said, I don't know the number, but let's say it's a third of all small business operators. I don't know if it is. I'm just using that as an example. Then now, if they're saying, okay, now you have to move your tax rate from, let's say, 32% marginal, not including the state, to 50% marginal, then at that point, or 52% marginal, I should say, you're talking about a 20% increase on the margin. What does a person do in that situation? I suspect that one response might be hire fewer people or pay less, offer less generous wages, offer less generous bonuses and benefits and such. So I don't think it's confined to merely 1.8% of the taxpayer public.
Yeah, it can definitely it'll affect more than that 1.8. I completely agree with you. Once this is all done and through, all this tax plan.
Yeah, it seems like it's always kind of like a give take relationship with kind of these stuff, kind of like a risk return trade off. Like you could bump up certain tax brackets, certain individuals, but if they're small business owners, that in turn kind of impacts
I want to offer some tips for people who are
so there's
looking
always
at this
this kind of
and some
two
suggestions
ends
and
to it.
discuss
That's always
what we're going to be doing
interesting
for
to
our
look
clients
at.
that are facing this sort of shift.
Let's just go over the next couple things, and we'll move over to that. Capital gains benefits.
Well, before you jump into capital gains, let me just talk about this one topic
Yes.
in terms of recommendations. Okay. And then I have some suggestions under the capital gains shift here. So in this case, what we're going to be trying to do, and this is not confined to us, I'm sure, but we're going to be trying to help our clients who would be affected by this to find ways to bring their income down, or at least bring their taxable income down. And so what are some ways that we would do that? Well, one would be to accelerate income that might otherwise be realized in 2022 or later, and see if we can't bring that into 2021 before those higher rates hit. That's one. Another would be to do some of that via Roth IRA conversions. So if we can bring money in.
Yeah, Eric, that's a big one. And we also have, just if you want to get deep into Roth conversions, our episode 57 is a really good one on it's like how smart
Adrian, thank you for mentioning that, because that's huge. Another would be from the standpoint of any gains
that's a big deep
that
dive
would be
into what
realized
talking about right
in
now.
the near term. We'd probably want to bring a lot of gains into 2021 and realize those. And while if you're selling a business, then this might be a time where you might want to get on that project of selling the business. And if you can complete the sale in 2021, probably that's going to be advantageous to you. Or if you can't complete it, then think about doing it in an installment sale to spread it out over time. And honestly, although I don't think the three of us use very frequently annuities, or because of the tax deferral properties of annuities, I might be talking with my clients about fee-only annuities that are, instead of commission-based annuities, so they're highly liquid, and they don't have any other layers of costs on them, but their sole purpose is to manage taxes.
Yep, and actually, I want to mention a couple other things on this plan because that business sale piece, when you talk about that, Eric, that's more with the increase in capital gains, right? The annuities piece, that's more to address the increased income tax. Well, I guess that would be the long-term capital, the dividends, potentially long-term capital gains, and the higher income, correct?
Some portion of the sale is connected to a gains piece. So they have to sort of scope it out, how much is related to gains and how much is related to, if you have, for example, consulting agreements, or you have the assignment of goodwill or non-compete clauses. Some of those those are treated as ordinary income payments, as opposed to, but yeah, you're right. It affects both categories of gains as well as ordinary income.
So I just want to mention the numbers on that. Long-term capital gains and qualified dividends will go up to 39.6% if you have an income over $1 million. So that's the big jump, where if your income's at that level now, you're paying 20%. So you're getting almost a doubling right there in taxes. So,
Well, and we should probably hasten to add that there's already a surcharge, the Medicare surcharge that's imposed on capital gains for those that are above certain thresholds. So for singles, it's $445,000 or $446 or so, and then for married filing jointly, taxable income above 501 and change. So there's already 3.8. So if you now raise that to 39.6 from 20, and you add the 3.8, now you've raised the capital gains tax rate for those in that bracket to 43.4%.
And actually, Eric, we should add this as well. If you're married and your income is below 500, or you're single and your income's below 445, you're currently paying 15, not 20. And I know that we're saying this would affect people that make over $1 million. Yes, but as we mentioned, that trickle down potential is always there when you add something like this in. So,
and can I say one thing about just capital gains taxes in general? People don't realize, if you said, how much has inflation gone up in the last 25 years on average annually? 2%, something like that, right? 2.5. So we're talking about if you have a compounding 2% return over, let's say, well, I'll just use 30 years, you have doubled the value of an asset just by inflation. So, but in this case, if you then say we're going to impose a tax on all of that inflated value,
Yeah.
you're really left with, you're taxing not just growth, you're taxing the inflation. So if you bought a home 30 years ago and you paid, I'm just making up numbers now, $250,000, it's now worth $500,000. 250, leaving aside the exemption, that's $250,000 on which you'd have to pay in under this scenario, over 40%. So basically they take $100,000 because your home inflated in value, and not because it had necessarily any real price gain.
Yeah, that's such a good point, because on the other side, if you're using the home example, you need that, you're probably buying another home, right? So you're getting this hit on your purchasing power.
I use the home example because it's a familiar one to most people, and they can kind of think in those terms. But there is a home exemption.
So, what you're purchasing, has also inflated as along with what you're selling. That's a very good point.
Well, the net effect of this is that if you do this, you move capital gains taxes to 39.6, and you have the 3.8% Medicare surcharge. What in effect you're doing is you're saying we're going to tax capital gains at a higher rate than we're going to tax earnings.
Yeah. Yes. Wow.
What?
It's crazy. You're discouraging investment.
Right. So in terms of things that we would be then suggesting to our clients, so a lot of our clients are invested in real estate, and a lot of our clients use 1031 exchanges to defer capital gains taxes. So goodbye is under one of the things proposed is to eliminate the ability to make 1031 transfers for gains above $500,000. And so if you're
Yeah, so I've interestingly enough, I'm working with a few people on this now, and I was speaking
and Roshan, do you want to kind of give a quick little
colleague of
overview on
mine,
1031 exchanges
and
for any listeners that
1031
might not be
exchanges are
familiar
very
with it,
popular
maybe
right
think
now. And
might
what
be
it
a fit
allows
for
you to
them?
do when you sell, if you have an investment property and you're selling that investment property, you can then put that money into another investment property. There are a lot of rules you need to follow, but if you put it directly into the other investment property, you're delaying the capital gains. And if you depreciated the original investment, you're also delaying, and possibly, depending on if you hold for your whole life, eliminating the capital gains and the recapture. And this tax plan has included in it the possibility of eliminating that, which once again, the part that gets to me with a lot of these tax plans, and I feel like I don't know enough to necessarily strongly take either side, so I'm open to opinions from both sides on it, quite frankly. But I'm just not a fan of discouraging entrepreneurship and investment in general, because I think that's part of what makes the country great. Right, that we have such innovations, and just it's being discouraged through some of this. There are other individual tax impacts. I don't know if there's actually a lot. I don't know if there's anything you want to highlight, but I do want to move on to the corporate tax structure as well. So Erik or Adrian, on the individual side, what else would you like to add?
Well, I would like to add some things that we're going to be talking with our clients about in response to the capital gains.
Yes.
If those are passed. So in addition to the things that I had talked about earlier, which included accelerating gains into 2021 and talking about Roth IRA conversions as a potentially very powerful tool, because then if things are growing inside a Roth, you won't have capital gains, hence you won't have those taxes. But I'd also just like to add that specifically related to assets with embedded capital gains, if you're not already using appreciated assets to fund your charitable giving, this would make it even more compelling to do it that way. In other words, don't sell an asset, take the cash, pay the taxes, and then give what's left. Instead, just gift the asset itself. And as a result, you'll avoid all of the embedded capital gains taxes.
Yeah.
There's going to be another one as well, which is to look for ways.
Stop you there for a second.
Mm-hmm.
I recently dealt with this with a client, and they asked me the question of how small of a donation should I at what point is the donation big enough where I should do donate stock, appreciated stock, as opposed to donating cash. And my response to they have a lot of appreciated stock. So my response to them was, as long as you're willing to deal with signing the paperwork, I wouldn't donate any cash. I would do stock at all time. Granted, there's additional paperwork. It's a little bit more than just writing a check because you have to transfer it over. But I just don't see a reason to. They have appreciated stock where we want to sell the stock, but we don't want the capital gain, right? It just makes no sense to me to do any other form of donation in this specific case. So I mentioned that for everyone listening, no matter how much or how little you have in appreciated stock, it's worth looking into.
And you can ask the charity how much would be their minimum. And I've never encountered a charity that had a meaningfully high minimum on receiving that donation. In fact, we've had charities that have opened brokerage accounts with us in order that they could indeed receive those gifted securities into it. But I would also say, coupled with another thing of potentially affecting individual taxpayers, namely the elimination of what we'll call the step up in basis, which we'll explain in just a moment. Now, I would say there's just even more reason to be thinking about using that particular mechanism for charitable givers, because you might say, look, I love XYZ stock and I've had it forever. Okay, so gift, and I've got 10,000 shares of it. Okay, gift 1,000 shares of it, and then go replace it by buying 1,000 more, and now you'll just have elevated the basis. In other words, the cost. You'll still have the same 10,000 shares, but you'll have eliminated the basis on 1,000 of those shares, and hence, if you then pass away, your kids won't be hung with the capital gains that are embedded in that. So step up in basis. You want to discuss that? Because that's the next, I think, really significant, and that will affect many, many more people than the second one we just described, which is what applies to people over $1 million.
Yeah. So the step up in basis, if you have appreciated stock, you bought stock for $1,000, it goes up to $5,000, you pass away and it goes to your heirs, they don't have to pay the tax on that difference. That's the step up in basis, means the basis goes up on your date of death from 1,000 to 5,000. So if your heirs keep that stock and it goes from 5 to 6, they'll have to pay a gain on that $1,000 gain from 5 to 6. They don't have to pay a $5,000 gain on the original $1,000 that you purchased it before you passed away.
Right. So if you say, so the proposal so far is to say we'll give a $1 million exemption for each person. In a married couple, that would be portable. So that would mean $2 million for a family. So this is probably not going to affect all families, but families that have, let's say, a net worth of $3 million, where we have many, a large share of our client base has a $3 million or more net worth. In that particular case, if you said, hey, we're going to get rid of that step up, now you have to ask yourself, all right, if that hits all at one time, namely at the point of settling the estate, how big a tax will that be? So what can you do to avoid that? And so here are some of the things that we're going to be talking about with our clients. So one is what I would call basis management. And that is to say, figuring out ways, if you still want to hold those things in your portfolio, just figuring out ways of resetting the basis to a higher level so that, yes, you incur the capital gains and you're taxed on it, but you're not taxed on it in really big chunks such that then the rate hits them really, really hard. It's way better to have a much lower tax rate on those capital gains taxes if you do it incrementally over time. Another would be you could gift that. We've already talked about that to charities, but you could also gift that, honestly, to, if you have parents who don't have as high a net worth, you can gift up to them. Then when they pass away, again, there won't necessarily be a step up in basis, but if they are in a much lower tax rate on capital gains than you, then those assets can pass right back to you, with a, now at this point, the taxes having been paid at a much lower rate. We will be doing at least annual rebalancing on clients' portfolios. And we're going to be even more. Remember, the last 2 weeks we talked about tax allocation or asset location as a strategy. We're going to be even more keenly focused on that. The power of having your high growth assets inside a Roth IRA now will be even more potent than it was before. And I'm going to just mention one other thing, which is something known as a charitable lead trust as opposed to a charitable remainder trust. Here, what you do is you put money into the charitable lead trust. It pays out a certain amount to a charity for the life of the trust. And then at the end, it reverts to either you or your beneficiaries. You can structure those trusts in such a way that then you essentially eliminate the embedded capital gains.
Yeah. And going back to this, just because you hear the $1 million number that you'd potentially be able to avoid on this new step up, and I just think of, so when you hear that number, I can hear some people saying, well, this may not affect me and so on. And I just think of a situation I had with a client not too long ago where they inherited land that had been in the family forever. Right. So if you've got a couple generations worth of a house, farmland, something like that, this could impact you, even if you think about it and say, well, I don't know that it applies to me.
Absolutely true. That is true. So I have one more on the individual tax side that I'll mention that I think is relevant. So that is there. Though it's less clear that this is going to pass, there may also be changes to estate planning laws of a variety in a variety of ways. So one would be to reduce the estate tax threshold. A second would be to eliminate or limit some of the really popular estate planning techniques for larger estates. Among them are grantor retained annuity trusts, or GRATs, family limited partnerships, and dynasty trusts, and intentionally defective trusts. Now, if you're going, what? Don't worry, we can come back to that in some other estate planning time. But if those are recognizable terms to some of our listeners, and you've had conversations with your estate planning attorney or other advisors or CPAs about that, let me just say, this is a good year in which I would say, watch this carefully, and this may be a very good year in which to take advantage of some of those techniques. So the implications for clients then I'd say, if you're under $3 million in this case, in terms of net worth for your family, I would say the strategy for you would be to just look for any highly appreciated positions in your portfolio and manage the basis on those. If you're above $3 million, then consider some of those more advanced gifting strategies and getting those done in 2021 in order to drive down the value of your estate. And you could use things like notes to children with really low interest rates. You could use what are known as spousal lifetime access trusts, and you could also use what I talked about earlier, which are GRATs. So anyway, those are some of what I consider to be really significant changes that will be affecting our clients at a personal level.
Yeah, and
Yeah, that's great, Eric. It shows how important it is just to be just proactive when there's these new like tax changes coming out or these new policies being implemented. Just showing how like a little structuring or moving some pieces or donating stock or just
So
whether it's to a charity or a
we
family
wanted to
member
talk
could
about
really
corporate
make a
tax
difference
rates,
and
and we
really
also wanted to talk
protect
about
you from
winners
like
and
a
losers. You
surprise
Well,
decide.
just one
tax
thing I want to
bill. And
clarify on the
it's just
estate
so
tax thing that you
important,
mentioned.
like we say, to look at the
Just
data,
a
look at
comparison.
what's
Currently,
coming
you can
out there, and
exempt
just being as
pass on
informative as possible,
11.7
just to kind
million.
of protect your
That's
overall
going
plan.
down to 3.5 million. So it's still it's I mean, it's being cut by almost a third. So it is a big drop, even looking at this. So some of the strategies Erik had mentioned, we will definitely go into the estate planning further. I think after what's passed, we can bring on a guest to talk a little bit about what's passed and what we can do about it. Now, continue, please, going on to the corporate tax rate proposal. Or I'll continue with the numbers on that.
Adrian, you had said that you had wanted to talk about that.
Well, I think, yeah, maybe one of the biggest questions I guess people will have is if there is an increase in the corporate tax rate, how will the markets kind of respond to that? I think that's a big thing, whether
I
it's
will
going to
answer
help
your
the
question.
markets
I
in
just want
one
to
way,
go over
or
the
is this
number
going to hurt
first,
the
the
markets
change,
in one way? I think that's
and then talk about what
question
would
people
sort of be a natural
would
shift.
really have.
But
And that's where, you look at the
the
data,
current
just kind of see
corporate tax
where
rate
things are moving forward, just to
right
kind
now
of see
for
what
corporate
happens.
tax rate
What do
is
you think about that?
21%, and it's going up to 28%. So now corporations will react and adjust, and that's only one part of it. There's additional to it. But Adrian, to your question, the natural move, if a corporation's earning 7% less, and this is overly simplified, but would be a 7% decline, right? If in theory valuations are based on discounted future cash flows, if cash flows drop by 7% a year, you should see at least a minimum of that kind of decline or a potential compounding effect. Either way, taking the calculation out of it, you would definitely expect a decline in stock prices, because stocks essentially represent an ownership share in a corporation, and if that corporation's earning 7% less, its value of its shares should decline.
Yeah. So I want to separate it into talking about both the market impact and then the economic impact. So first of all, we should mention that previously the U.S. had a tax rate of 35% at the corporate level.
Yep.
And the Tax Cut and Jobs Act of 2017 lowered that to 21%. So 21% made the tax rate not the most competitive, but certainly among the organization, the OECD, Organization of Economic Cooperation and Development, I think is the title of the OECD countries. We were sort of in the middle of the pack, because at 35 we were off the charts way higher. And as a result, there were strong incentives for multinational corporations to locate a lot of their activities overseas, including a lot of what they would consider to be their intangibles. So they would characterize their intangibles, like intellectual property and so forth, as residing elsewhere, even if a factory might reside here. And then they would then attribute certain profitability to the intangible assets as opposed to the tangible ones, and hence those could be taxed in settings with much lower rates. So, for example, I think Ireland, if I'm not mistaken, has about a 10 or 11.5% rate or something along those lines, and which was a favorite destination for a lot of these things. By bringing it down to 21%, it at least brought it down more into the middle of the pack. And there were some other adjustments that went along with that. If you raise it from 21 to 28, you're raising the corporate rate by 1/3. Does that, you see, 7% is 1/3 of 21. So you're going to say, we're going to raise your taxes by another third. Well, on top of that, corporations pay state taxes where they're located. And so the average tax rate that corporations in this country pay is at the state level is slightly more than 6%. So if you say 28 and 6, now you're at 34. That puts at 28% alone, we would be the third highest tax rate in the OECD. But if you add in that 6% on top of it, now we are the very highest rate again, which defeats the purpose that had been to make the United States more competitive as a location for and as a destination for multinationals. So at this point, I think the consequence is that you're just going to start forcing these corporations to ask themselves once again whether they really want to locate operations here and whether they want to suffer these tax rates. I don't know that it's not like if you raise the rate by a third, you don't gain a third more in corporate taxes. In some ways, it's I think self-defeating. So in any case, aside from the wisdom of it, that's at least what's on the table. And you might think, well, it's confined to corporations. No, it also affects workers. It also affects investors, which we've talked about. And so on that level, at a lot of levels, I'm not super excited about that particular proposal.
Yeah. Yes. And when you bring up the employees and investors, everyone is really going to be affected by it. There are a couple other things on the corporate structure that I think one that's really worth noting is the minimum tax on corporations that book profits of 100 million or higher of 15%. And then they're also going to try to go after foreign subsidiaries with an increased tax. So what you're doing is, you mentioned making the United States a little bit less competitive. You're also closing some loopholes where you could either be abroad and still work here, to where you'd be forced to almost take your whole corporation somewhere else if tax is the primary thing. Whereas there were still sort of ways around it, where I remember seeing years ago where corporations would have an office that would really be like a mailbox in a different country to get around some of the tax laws. However, they were still in the United States and they were employing people there. Right. So if you force those corporations to say, well, you can't just have a mailbox as your loophole, you have to actually move. Well, now you've just shut down that center, whether it's the factory workers, whatever those employees were, but those employees aren't going to move. In most cases.
So, well, guys, I would be happy to talk about winners and losers.
Let's go over that.
Let's
go over winners and losers and wrap it up. And we will definitely, I imagine, be coming back to this after it's passed.
So I'm not talking about winners and losers from the vantage point of the ramifications of the spending so much. Although I'm gonna touch on that just a little bit in this, I guess, because in the winners category, it's unavoidable. I'm mostly focusing on the tax elements of it, but in this case, the taxes flow in reverse. So first of all, winners. That would be taxpayers under $400,000, because at least in this case, they're not directly subject to some of those increases in those various rates that we were talking about. So that's number one. The second would be low and middle income families. And I'm going to use middle income advisedly, because middle income in the use of this is stretching in some cases up to the $400,000 level. And I don't think we normally consider somebody who's making $350,000 a year to be middle income, but we'll go with it for now. So but that's true for families with or without children. So how is this happening? Number one is the child tax credit. And so the child tax credit now would be for 5 years. You would be paid through a transfer into your checking account, $500 a month for kids ages between, or pardon me, not 500, sorry, $250 a month for kids ages 6 to 17, and $300 a month for kids under age 6. Now that's phased out for couples who are married filing jointly above 150 and singles above 75. But nevertheless, that's a lot of money that's just changing hands as a tax credit, not a tax deduction, as a tax credit. A second version is the earned income tax credit. And this would apply to low-income families without kids. So as you might remember, the American Rescue Plan, which already was passed, that tripled the maximum benefits for this earned income tax credit. And it's as high as $1,502 a year for that. Next, working parents. So working parents can get a tax credit of up to $4,000 a year for one child, $8,000 a year for two or more children for childcare. And how that works is that up to 50% of what they're spending is reimbursed. And this is true for households with incomes of 125 or less, with partial credits stretching up to the $400,000 level that I mentioned. And then the third winner would be Affordable Care Act customers. There's still not all the details have been settled here, but for those households that have income somewhere between 100% and 400% of the federal poverty line for a household of their size, then they would have extended caps on how much of their household income could be spent on premiums, and the rest would be subsidized. So those are the people that I would say are winners, broadly speaking, in terms of tax credits and spending caps. And then there's a couple other categories which are a little bit foggier at this point, but there may be that you will get if you make contributions to your 401k, irrespective of your income tax bracket. You could get a 26% tax deduction for that, which if you're in a 12% bracket and you can get a 26% deduction for let's say contributing $25,000 to your plan, well, that's pretty powerful. So guys, comments about any of the winners?
Well, each of the categories you went through of winners are, at least the first two are pretty straightforward, right? If you're making under 400,000, they're saying a lot of this won't impact you, right? So that's where a lot of it comes in. You do get those other credits at lower income levels, but if you're under 400,000, you're relatively unchanged right now. And I know we were saying winners or losers, but with what you get hit with, if you're above that level, I would definitely classify unchanged as a winning situation.
Yeah, right. That's right. I would too. Adrian, did you have anything you want to say about that? Otherwise, I'll talk about losers. Okay. So losers, I've got 6. So one is going to be high earners, and we've talked about that at length. So you understand what just the question is what is high earners in this case? Is it families or individuals at $400,000 or more, or is that just the sort of loose talk? And really, the place where some of these things is going to be imposed is at currently at the 37% rate or higher, which, as we said before, was 523 for singles, 628 for married filing jointly. So that's first losers there. Second losers would be heirs of large estates or those that have highly appreciated stock in their net worth. The third would be investors that are realizing more than $1 million worth of capital gains in one fell swoop. The fourth, which we don't have any in our client base, maybe you have in yours, but at least we should know about it, is hedge fund managers who've been able to use a lower tax rate on what's called carried interest, and now would have to pay ordinary income tax rates on all of that. Number 5 would be, as we talked about, high earning real estate investors, both because of the impact of the limitations on the 1031 exchanges, and if they eliminate the step up in basis, that could be huge in terms of hurting them. And then finally, one I'm super glad about actually is that the federal government is going to be, these proposals include $80 billion more to the IRS. Now you might say, what? Why are you excited about that, Erik? Because at least the express aim of that is to step up enforcement among people who have been not complying with tax laws. While I don't like taxes, what I hate more than taxes is non-compliance with tax laws. So from that standpoint, if they can catch people who are cheating, then cheaters would be losing. So there you go, gentlemen.
Yeah.
Actually, I have a few friends that will hate that. Yes, unfortunately.
What I said to Adrian was, well, that means I've got a viewer also. So hopefully they hate me enough to come back and watch again and give me more dislikes. So
You might have some haters that might come out if they hear that,
your
Eric.
winners
But
and your
I like
losers
that.
list, I also think is sort of pretty
I was joking
straightforward.
Roshan
But
too. One of our YouTube
I
clips
have no
had a
data to back
dislike, and
this
it was
up, but
Roshan
I'm concerned
talking, so
about
he
an
has a
overall
hater too.
economic
So, but
impact. A constantly stated
Yeah.
thing is you don't raise taxes in a recession, and mathematically speaking, we are not in a recession, but we are recovering from the pandemic. So it just seems like
Yes.
raising taxes slows growth, and we're potentially looking at raising taxes. And you can make an argument that the people that are making over 400,000 are one thing, but when you raise corporate tax rates, you're going to impact employment, right? And you're coming out of this recession. You don't want to impact employment. So that's a topic for another day, but that's another one I'd add to your losers category, which kind of impacts everybody, but it's employees whose corporation will now pay a higher tax, because inevitably it'll impact the employees, or even you can say consumers who are purchasing from corporations paying a higher tax, because you're either spending less money internally or charging more money externally, which could lead to forced inflation in what we could already be in a higher inflationary environment.
Yeah. Yeah. If people are wondering, about what are some of the economic impacts of this, then I would say here's a couple sources that I think are going to be understood as close to neutral. One is the Wharton School of Business at University of Pennsylvania has an econometrics group that attempts to estimate the impacts of these things, and they in their approach, they estimate both the impact of the stimulative effects of the spending as well as the anti-stimulative effects of the taxation, and then sum them up. And so you can see how they come out on it. It's uniformly negative on both the GDP growth over time and on the national debt. And then there are other groups like the Tax Foundation, which are very keenly focused on these sorts of things, and the National Taxpayers Union, as well as a variety of other think tanks.
Yeah, and just mentioning other sources out there. I've got a few as well that we'll share in the show notes. But gentlemen, anything to add in closing on this episode, really about the tax effects of the new Biden proposed plan?
Nothing, Roshan.
Yeah.
Thanks for asking.
Yep, and
I will say.
Go ahead.
I just want to say to our listeners, if you're just a listener and not a client, which we have clients listening, but we have others. If you'd like to have a conversation about these sorts of things, if you'd like to understand how these rules and changes might affect you, and you're not working with someone who's attentive to these kinds of things, please reach out to us. Our contact information is in the show notes, and this is what we do for a living. We're here to help.
Yeah, we're definitely here to help. Reach out to us with anything you need. Also, share our information about our podcast with your friends and family. Like, subscribe, give us 5 stars. If you hate us, give us 5 stars anyway, like my dislike on YouTube. But if you have topic ideas, please send them out. We want to give you information to help you do better in terms of your financial plan, but your overall financial life. This has been another episode of the Retirement Lifestyle Show, and we will see you next week.